I think we can start as the head count reaches 30 already. That's half of the registered. But yes, I think since we have a dense schedule, hello everybody to our webinar From Evidence to Investment, what makes nature-based solutions finance relevant. In literally any other circumstance, I think I would have expressed a very warm welcome. But given that we are suffering a record-breaking heat wave all over Europe, and you probably also had a rather warm night, maybe let me express a cool or even cold welcome to all of you. So I think the scene for our topic could not be set more urgently or more topical, because what are we talking about today? Let us take a simple example. Suppose every European citizen you would ask this morning whether he would be willing to pay, say, 100 euro to reduce the heat outdoors, right? And say, suppose this 100 euro on average would be agreed to you. So if we exclude Russia, we have got 6 million Europeans out there. And so in that way, we could collect 60 billion euros for the purpose of reducing the heat outdoors. We know well that nature-based solutions are quite efficient cooling systems. So you would have the equivalent of, well, say, the market capitalization of the biggest German bank, the Deutsche Bank, is also 60 billion. Yesterday evening, I looked it up. So that would give us quite a good fund, equivalent to the market capitalization of the biggest European German bank. Yeah, to do something about the heat with green, blue infrastructure, for example. To invest this money to the benefit of all Europeans. Okay, so I know the world is a little bit more differentiated than this simple story. And this is why we are here, because it is a bit more complicated. We have got 3 experts from 2 European projects. So welcome Linda Romanowska, Fabiola Schneider, and Lydia Linhardt from 2 European projects, Invest4Nature, which is hosting this session, but also from Nature-3B. Well, the 3 Bs from this project stand for benchmark, bonds, and banks. So we are in the middle of the topic. And then we have got 3 renowned experts from outside academia and outside research, who are really will give us a feedback on what we are doing so far in these 2 projects from practice. So I'm very happy to announce that Maria Elisabeth Brückl of Raiffeisenbank International, Martin Zenke and Maximilian Kulhanek of Unica Insurance Group, both hidden champions with a strong business foothold in Central and Eastern Europe, are with us today and will share with us their insights. To make all of this a success story, I would like to ask you maybe to write in the chat who you are, introduce yourself. So I'm not talking about the 6 speakers, but you, the audience. Usually we get most out of such meetings if we already start communicating during the talks. Please note also that the entire session is being recorded. Hope you are fine with that. Okay, so that's for the introduction, and I'm very much looking forward now to Linda's and Lydia's, so the double L's, introduction to nature-based solutions and Invest for Nature. Please, the floor is yours, and then we are looking also forward to Fabiola's presentation from Nature-3B.
I think I will start now. Franz already introduced me. I am Lydia Linhardt. I am an economist by trade, working at Joanneum Research, which is a big research institute in Austria, in one of the bigger EU-funded nature-based solutions projects, Invest4Nature, as you already heard. And when I was looking through the registration list for today and saw that there were a lot of people who registered that are outside of the usual NbS bubble, I was not only very excited, but I thought we should quickly introduce the formal definition of what nature-based solutions are. Nature-based solutions are actions that protect, sustainably manage, or restore natural or modified ecosystems while addressing major societal challenges in ways that benefit both people and nature. NbS always provide biodiversity and ecosystem benefits, and they always promote equity, well-being, and local engagement. And they tackle diverse challenges such as climate change adaptation, mitigation, but also water management, livable cities, food security, health, or job creation. And some of the very easy examples that most of you probably know is like greening streets in the city, or also green walls and roofs in the city, but then also nature-based solutions in agriculture to help the soil retain more water, to prevent floodings and the effects of extreme precipitation events. But then also nature-based solutions could be coastal dune restoration, to protect the coasts from extreme weather events. And other NbS include river renaturalization, so that the riverbeds are running, meandering more, so also to prevent the flood risks. And those examples I just mentioned are taken from the Invest4Nature project, where we include 5 living labs across all Europe, where we looked into this. And what I'm presenting here today in particular is demand and supply for NbS. Because I am an economist and I can't stop being an economist, I need to find out how are nature-based solutions right now integrated in value chains across Europe. We wanted to look into this in the Invest4Nature project because, of course, we need more nature-based solutions. We could talk a whole hour about how we need more investment into biodiversity restoration, into nature protection, and nature-based solutions in the next years to address societal challenges. And in order to improve this, and in order to also be able to mainstream nature-based solutions into our economy and society, we first need to look at what is right now the case. So which sectors are right now driving supply and demand for NbS, and also which are the barriers and drivers for NbS uptake in different sectors. And then in our report, we also issue policy recommendations following from this. So what we did in the report was a huge literature review, and then also we did a business model canvas mapping and input-output modeling of the 8 Invest4Nature living labs. So we have 5 living labs, and then some have multiple cases, so that's how we come to 8. And on the slides, I also posted the link to the full report, which we can also post later in the chat and send to you also as a full follow-up, because it's a really exciting report. And one interesting insight I'm showing here is this Sankey diagram, where you can see on the left side the supply sectors, and on the right side the demand sectors. And in the middle are the nature-based solutions themselves, which we split into the different landscape types. So urban nature-based solutions, inland water, coastal and marine, mountainous, agriculture, and forestry. And this is, as I just said, taken from the literature review and the Invest4Nature Living Labs, where we analyzed all the existing links. And as you can already see, I'm trying to point here. I think I can point. No. Okay. Anyways, as you can see here, there is the strong role of the public sector. We have split up the public sector into its different levels. And on the supply side, there's mostly the local and the regional and national public sector supplying. And on the demand side, on the other hand, you can see on the right side, there are all levels of public sector involved there. So the local, the regional, national, and the EU level. So they are right now the biggest funders of the NbS across Europe. And one easy example for how this supply and demand interaction of such an NbS with the public sector would be that, for instance, there is, for instance, EU and national co-funding for a certain project, for instance, combating urban heat islands. And then a city, for instance, city of Vienna, would apply to receive that funding. And then the local public sector responsible, which would then be, for instance, a certain department of the city of Vienna, for instance, the Stadtgartenamt, which would be like the city's responsible department, to really implement then this nature-based solution. This is how a lot of NbS are run right now. That's also why you can see that the public sector is very dominant here. But also then you can see there's professional and technical services on the supply side that they are also often involved, that include gardeners, landscape architects, tree nurseries, and so on. Then also NGOs are involved in the supply of NbS a lot of the times, especially also, for instance, with coastal NbS, where local NGOs help restore dunes, for example. Academia and research is also big in supplying. They usually supply the corresponding evaluation and impact assessments. And then agriculture and forestry oftentimes do actions that count as NbS and then count as suppliers for NbS. Then we also have utilities and infrastructure. For instance, if the train tracks are greened or there are NbS involving that. And then residents are usually also involved in maintenance, or sometimes involved in maintenance. And then we also have fisheries, marine, real estate, education, and health. And on the demand side, as you already see in the graph, the supply side is a bit more connected and the more diverse one, because of the supply relations are usually the ones that are more obvious.
Can I give a time hint? 7 minutes are up already.
Okay, thank you. Yeah, and so then I will be a bit quicker. As you can see here, there is still a big potential on a lot of sectors. So you see health, education, real estate, there's still a lot of potential there because NbS can really help address big problems there. Then I will just now skip the barriers and enablers and shortly present the policy recommendations that we found. That one important thing is to alleviate the public sector bottleneck, so to increase the accessibility also to private sector actors to participate, fund, maintain, and manage NbS. Also establish long-term EU funding and other funding, but mostly also importantly EU funding for NbS maintenance, because the maintenance funding needs are often times overlooked. Streamlining NbS policies to strengthen demand across governance levels, and then also, of course, leveraging EU sustainability legislation for private sector investment. And with that one, I think this is already a really good bridge to the next speaker, who is Linda Romanowska, who will talk a little bit more on her survey, how to include the private sector.
Thank you. Yes, let's jump to the next slide. So I have put everything on one slide. That's easy. We don't need to move across the slides. So this piece of work is the work that we did as part of Invest4Nature that was led by my company, Melmus Advisory, as the research partner in the project, where we carried out in a survey and interviews with private capital providers. So the different types that we're talking about are mainly investors, so usually equity investors, typically funds, not always equity, but let's say funds as investor, and also lenders, so banks, credit institutions, as providing mostly debt-related capital. We did speak with a few insurance providers, but mostly from their investment perspective rather than from insurance services perspective here. And so the question that we tried to answer with this part of the work was trying to see, is there an interest, is there an appetite in the private capital markets to invest in nature-based solutions? If yes, how, why, and if not, why is that not happening? What are the reasons and what are the possible barriers? So quite a few insights here and quite interesting, to be honest. So first, which is really encouraging, is that there is appetite. And maybe there is no appetite across the whole spectrum of every type of investor and lender, but the ones that specifically position themselves as sustainable investors, impact investors, responsible investors, or maybe they don't even position themselves that way, but they do have sustainable investment strategies or frameworks. Those are the ones that signaled the highest interest. Now, on the other hand, what we saw, although they are a warm audience and they're interested in biodiversity and nature and nature-based solutions, are often incorporated in their sustainable lending or investment strategies. Very often they told us, yes, we recognize this, but we haven't started operationalizing this, so we're not yet investing, with only a very few percentage that we're actually already investing in anything nature related. On the other hand, point number two, most of them saw nature-based solutions at least somewhat investable. Now, not highly investable, none of them said that nature-based solutions are highly investable, and we'll speak later about why. So the average scoring was about 1.2 out of 3 in terms of investability, but very few, the very small percentage said that, no, we would never consider, we don't consider this bankable or investable at all. The highest potential sits in certain types of nature-based solutions or where they are applied in certain sectors. You can see that in the box number 3. And the reason why these were seen as more investable or bankable is simply because the entities were more familiar with these sectors already, because they're already investing or lending to them, working very closely, and they know what the benefits of nature-based solutions can be. And also because in a lot of these solutions, there is a clear revenue stream that can guarantee return on investment or payback of the loan. So typically, these were the two reasons why we saw certain types of NbS being more popular, more of interest to the capital providers. The other question that we asked was, what are the different financing instruments that you see as most suitable or preferred? And there was a clear winner. Very high percentage did say, we did have quite a long list, so no one got 100% saying that this is the most suitable one, but the highest percentage was green bonds. And what was interesting, that every type of entity participating was naming green bonds as the most suitable financing mechanism for nature-based solutions. And it's quite easy to understand why, because essentially it is the green bond issuer that guarantees that this nature-based solution complies with certain standards and certifications. They need to actually prove that. They will be reporting annually on their potential impact, depending on which green bond framework they follow. And it is their rather their credit score that guarantees the return on that bond, right? Rather than risk factors that are inherent in nature-based solutions projects themselves. And so it is already a de-risked, well-defined instrument, already predefined or at least scoped types of nature-based solutions or specific projects. And so we did see that quite highly preferred. There was some interest in early stage equity and special purpose loans. Equity can be twofold. It can be equity in special purpose vehicles that are set up for specific nature-based related projects, or it can be equity, for example, in entities that enable or help build nature-based solutions, different innovations that are coming through. Bankability generally was not a term that was used universally. We didn't find that, or investable at all. Every entity had their own word or term that they typically use. And they also looked at different aspects that determine something as bankable or investable. And there was a clear split between investors and lenders. Investors look mostly around their sustainability fit. Does this fit our investment thesis, the topics that we typically invest in? And can we get a return on investment in terms of value growth, so capital growth? However, the banks and lenders mostly looked at the recipient health. So they didn't look so much at the project itself. They wanted to know whether this recipient has financial health that will allow them to repay that loan. So that was a much stronger aspect for them. Barriers, I don't think I have to repeat barriers. There's a lot of research out there on the different barriers, but the good news is that a lot of these players did see certain barriers as fixable or solvable. And in fact, Invest4Nature project is solving some of them, those related with data, methods, knowledge. So we are building a toolbox in the project. And some of these issues, however, are inherent. And in my conversations with these entities, they also said, well, we don't have to solve all issues that are inherent and inevitably will always be there when we talk about nature-related projects, such as that there's a public good component, which is very often hidden or broadly distributed, where we don't have one recipient that is ready to pay for it, for example. We simply need to work with it and around it, and it is possible. The last bit is, again, quite interesting because very often when we spoke about what are the necessary solutions, yes, there was this component of knowledge and tools and better data, but there's also a big call that actually we need policies to move first. We need clear signal that governments and entities and the public sector is willing to invest in this, and there are strategies and there is a coordinated approach around this. And then the private capital will follow because they will see where is their place, where they can play in this environment. The types of policies areas that were named more often was that they wanted clear targets on nature, either separate nature or somehow nature linked to climate or embedded in climate. And if nature-based solutions are specifically mentioned, that is great because that gives very clear signal for investors in terms of what is in demand or what is required and where they can play. Also mandated biodiversity offset or credit schemes were mentioned. Now there's a big debate about biodiversity offset. It's really hard to get biodiversity offsets right. However, if they can be gotten right reasonably, then that was certainly favored as that creates that return on investment or income stream from biodiversity on NbS that benefit biodiversity. The last bit, again, interesting, there was almost an anonymous call for better integration of nature-based solutions in sustainable finance frameworks, policies, standards, such as taxonomies, green bond standards, etc. And in fact, on the basis of this call from the private sector capital providers, Invest4Nature, we have developed another deliverable, which actually looks at taking the work that has been done in the EU platform on sustainable finance on NbS integration in the EU taxonomy and taking it a step further. And hopefully this can now be handed back to the platform, which I'm a member myself and Fabiola as a member as well. So potentially this can now directly feed into that policy making process and take some steps forward as well. So this is all the key insights. I'll stop here. If anyone is interested, we can discuss any other details at another time.
Thank you so much, Lydia and Linda. And now we move to Fabiola's presentation.
Yeah, thank you so much. So Fabiola Schneider here. I'm an assistant professor in accountancy at University College Dublin. Linda already kindly mentioned one of the many hats I'm wearing. Yes, also supporting the platform on sustainable finance, also sitting on ESMA's sustainability committee there. But I'm delighted to today actually talk about a different project of ours. At UCD, we're co-leading a big Horizon grant called Nature-3B, which targets to include nature in decision-making of central banks, investment benchmarks, and bond issuers. You see all our fantastic partners on this slide here, and we have a whole range of different topics to cover. Given that I have 5 minutes today, you're only getting one. That is savings. That is our proposed framework mechanism for nature credits. So perfect. If we can move to that slide. What are SAVINs? What is this fantastic acronym? It's scalable, auditable, valued impacts on natures. So the basic idea is that we would like to allow banks who pay borrowers to create audited impacts to sell these as nature credits. That is a sustainability-linked loan. The other route is the SLB, the sustainability-linked bond, where we would like to allow issuers who created audited nature impacts to sell these impacts as nature credits. So the very basic idea is to leverage an existing financial instrument, namely sustainability-linked debt, so SLLs for banks or SLBs for issuers, as a way, as an alternative to mechanisms that we know so far to create nature credits. The overall idea would be a bit of learnings from the voluntary carbon market, the VCM, and avoid some of the governance challenges we know from there, and overall to support the creation of more nature credits, which of course means the creation of more nature impact. If we can move to the next slide then. Perfect. So this was the very basic idea. I hope you're somewhat familiar with green financing in a very nutshell kind of way of saying sustainability linked versus green loans or green bonds. One is the use of proceeds that you are maybe familiar with. That's green bonds or green loans. Here you promise to spend the money on a certain project. So it is a spend-based way of looking at it. I'm promising to spend 1 million on exactly this one project. It's ring fencing in an ideal world, the spending, the money. So the use of proceeds are committed. The sustainability linked structure that I'm talking about here is a bit different. Here, it's a general finance instrument, which means you can spend the money in any way you want. It's not ring fenced, which of course means any new loan or bond could be sustainability linked because it's a general finance instrument. What is then the key aspect here? The link is tied to outcomes. So it's a performance-based tool. In a covenant, so in a legally enforceable contract, you commit to a forward-looking target. You say, in 5 years' time, I'm going to have improved my soil quality by 5%. And that's written into a contract. And if it is achieved, indeed, when the time has come, then your cost of financing goes down. So for a borrower, the bank will then grant you cheaper cost of borrowing. And for the issuers, you will get a step up or step down in your coupon payment. So your cost of financing is directly linked to the outcome, whether you achieve that KPI that you set to begin with or not. That already exists, so that's not my contribution here. The SLB market is quite large already and quite broad. The SLL market likewise. I can share some examples if you're interested. For example, for agriculture, the UN FAO has a really interesting report that shows how important sustainability loans are getting for the sector. What we are suggesting is this mechanism that now brings the nature credits into the conversation. So we are saying the mechanism goes as follows. I'm using the loan structure because of time. The bond structure works very similarly. But first of all, our borrower, say a farmer, commits in a contract to achieve a certain impact. That's a covenant and that has a sustainability KPI. For example, if it's a farmer, that improvement of soil quality. In the contract, there's already also the financial reward, so the change in interest rate or loan margin, that's already in the contract, so we know it up front. Then time passes, our borrower needs to achieve that impact target, they need to report on it, and they need to verify it. That's the traditional process that's already happening as part of SLL loans, so that is a well-established framework and mechanism. And the bank, of course, has a big incentive to actually check, is that impact achieved? Because if it is achieved, then the borrower receives the financial reward as per the contract. Now, while that sounds great for our borrower, cheaper cost of capital there, this unlocked financial reward for the borrower, of course, for the bank means less money. So that's a loss for the bank. And at the moment, the bank is just bearing that. Now, we can ask, why do banks do sustainability-linked loans? There's plenty of explanations of, well, they have to report it. Risk management, is it preferences, is it just the glow effect, the good of their heart? But ultimately, given that it's a loss, there is a limit to how much a bank will do, because they won't do the entire loan book in terms of sustainability loans. However, what we are saying is, well, we have an impact that has been reported and verified. The bank that is bearing this loss currently should be able to sell this impact as a saving, as a nature credit. Therefore, the investment in nature would then be attractive both for the borrower that gets cheaper cost of capital, as well as the bank that gets to sell on this nature credit that was created. If we can move to the next slide, which, yep, exactly shows the difference between the existing default nature credit process and what we're suggesting. I hope it becomes clear why this bank loan structure is a real benefit both for the borrower and the bank and nature. So typically, and you may be familiar with the process of how credits currently work. So you want to do a project that has a positive impact on nature. First of all, you need to raise funding. Someone needs to put up cash pre-financing in order, for example, to purchase land to put the trees on. That's the big risk that someone needs to take upfront. So cash, someone needs to put money on the table. Then time passes, our nature credit is produced, hopefully, and we need to get it audited. That audit is usually done by a third party that specializes in this field and usually benefits from as many projects and as many audits as possible, which means that the interests are maybe a bit too aligned and not balanced. When that audit is done, there's two outcomes. Either, yes, your impact is achieved, or it's not achieved. The problem, if it's not achieved, then your cash pre-financing is lost because you do not get your money back. Whatever was spent is lost. If the impact is achieved, however, we're not ready yet to sell our nature credit. It first needs to be valued. Someone needs to put a price on it. That, again, usually is done via third parties, or some broker gets involved, and that, again, adds a fee burden to the whole process. And the incentives are maybe not perfectly aligned in terms of valuing it fair. What is the process then for savings, and why do I say there's a big benefit? Well, first of all, we're bundling the financing into our loan or bond. The whole point of getting a loan or a bond is you need to pay it back, right? So that's an independent financial instrument. Thanks to the covenant where we're writing our impact criteria, but also the step up or step down in coupon or the change in margin, we already know the valuation. So someone has already put a price on the impact because the bank says, if you achieve this impact, this is how much cheaper your financing gets. So the valuation is done at no additional cost in that sense. It's included, bundled into these existing structures of SLLs and SLBs. Just like in the other case, now our nature credit production is happening, whatever impact needs to be achieved is hopefully worked on. Then we get that audit, but that audit is also already included in the SLL, SLB structure, and the interests are a bit more balanced because the bank who bears a loss if they grant you that cheaper cost of financing will really make sure to do their due diligence and to check whether the impact was really achieved. So the interests here are balanced because the bank actually gains from proving that you didn't achieve your impact. Next step, we have our verdict. Is the impact not achieved? That's not a problem because the bond loan financing just continues as usual. The cost of financing doesn't change because the impact wasn't achieved, but the bond or loan still needs to be repaid. So it's still a normal debt instrument, general finance instrument. So no one loses that cash pre-financing that was needed in the beginning. If the impact is achieved, we're also ready straight away to sale because we don't need to value it anymore because that was done at issuance in that covenant.
I think 6 minutes are used up already.
I was going to say my last slide then, I think, if it's still there. Yeah, that shows you the benefits across the 4 pillars. So I said auditing, valuation, and financing risk are bundled into our instrument, which means that the scalability is much more likely because the financial risk is not there to discourage anyone to do the project. Plus, we have the balanced interests, which kind of provides a better incentive in terms of greenwashing concerns. So overall, I hope Savings will be a scalable solution for nature impact. Happy to discuss with anyone after that as well.
Okay, thank you so much, Fabiola. So we've got a lot of insight from theory, more or less, now. And since we know that in Europe, I mean, we are world masters in regulating, also in inventing very nice procedures and instruments that work very well in theory, I think we also need to look into practice. And I'm very excited to welcome Maria Elisabeth Bruckel now to share your interests, your insights, well, from the practical side. Is it working?
Well, that's a strong question to start off of.
you start with whatever you like to.
Yes, maybe I'll give you a little bit of a background first. I'm working in the group sustainability team at RBI Group in the head office in Vienna. And we are a banking group, as I'm sure many of you know, who is mainly active in the CEE region. We have about 43,000 employees and service approximately 18 million customers across those countries, 11 CEE markets in total. And I joined RBI actually in 2023 when the implementation of the CSRD was just starting. And with this, biodiversity became one of the topics that we began focusing on more closely. And for this, RBI also joined a Horizon project, of those some have been mentioned before, which is called Circhive, where we actually also go through the process of looking at our biodiversity impact, not just the footprint, but also the risks, and basically go through the whole process of learning how to measure and how to estimate and look at the data. And in this process, of course, we also see the technical limitations and the problems that not just a bank, but also, of course, then our clients would face when estimating biodiversity impact or when proving that their biodiversity projects are valid and valuable. But still, we've also taken first dips into the green bond market specifically. We had a financing where we supported Verbund, which is Austria's largest hydroelectricity provider. They issued a green bond with focus on biodiversity in 2024, and RBI was part of the consortium supporting from the banking perspective. And so green financing, sustainable financing is, of course, a large part of also what RBI is doing. But we see a number of limitations currently, which also have been mentioned previously. So the data availability, the whole structure around validating a nature credit or a biodiversity project, which of course offers risks of greenwashing for a bank that we need to avoid. So really to have a good policy framework that offers security for banks, for the companies that we cooperate with, the clients, is something that is still lacking in a way, and where we would hope that the future would bring more clarity as one of the points. But I think it's quite interesting to hear the different approaches, and I definitely recognize some of what we've also analyzed and seen in the projects that were mentioned before.
Oh, thank you very much. Thank you also for your time consistency. And now we move to the insurance sector, also from an ESG perspective, but also from an investment perspective. So Martin and Maximilian, thank you for your insights.
Thank you, Franz. Maybe short introduction. I'm Martin Senker, head of the Group ESG Office of Unica Insurance Group. Unica Insurance Group, a similar footprint to Raiffeisen Bank International, also very active in the CEE region with a total of 14 markets where we are active in, with roughly 18 million customers. So European-wise, a medium-sized insurance company with a strong CE focus. So I want to draw the picture a little bit broader of how what our position on this topic is. And starting that we are generally as a group very committed to sustainability and have quite an ambitious sustainability strategy and transition plan, mostly focused on climate. And this was the main topic for the last year, since 2018. We're a member of this Austrian Green Finance Alliance, which is a ministry-led initiative for banks and insurance companies that give very clear and very, very strict and ambitious guidances on how a bank or insurance company, what they should do in order to transition their portfolios towards net zero. And based on that, we have very strong positions, as I mentioned, on climate, fossil phase out, decarbonization, CO2 reduction, and a very big focus on sustainable investments, where we already have quite, and that's what I liked also what Linda said, and which I can very much confirm, that we have a very big focus here on green bonds right now, with like roughly, I think, 2 billion, roughly 10% of our assets under management already in green bonds. So definitely something that we did focus on in the past already. but we are very much driven by regulations. This is what keeps us very busy. So starting with the taxonomy and the SFDR, the sustainability reporting, which gives us quite a tight corset also on where we can move. I mean, the EU taxonomy, unfortunately, is something that is very directly said rather useless for steering anything here. Also has two sides for insurance companies, not just for investments, but also for our underwriting side, where the taxonomy really doesn't help us at all. But still, we are very, very driven somehow by that. And for us, the topic of nature-based solutions, as also Maria mentioned it, is mostly linked to biodiversity since, I think, 2 years, where we just get more and more feedback from different sides that we have to tackle the topic from a risk management perspective, but also from a positive impact perspective, because of course, as a big asset owner, we have quite a lever here, and which does help us for getting closer to this topic is that the Austrian regulator, the Financial Market Authority in Austria, also has more and more a focus on this topic and asking banks and insurance companies to at least start exploring the topic on a very high level. And that's what we started also, starting with awareness in the group, starting from the board to until the supervisory board, to have awareness. What is this actually? What is biodiversity? What are nature-based solutions? What is nature, and what do we have to do with that? And there we took first very basic steps, I would say. But maybe I will stop here, Franz. We can explore it maybe in the next round a little bit more how we started with this.
Thank you so much for your first input, and it's, I think, really a very good idea to now switch in one and the same company from the ESG perspective to the investment perspective. So Maximilian Kulanek, thank you for sharing your insight with us.
Great. Thank you for having me, and it's a pleasure to be part of this discussion. So while Martin was referring to what's happening on a more strategic, aloof level, I would say we are at the asset management side trying to effectuate it via investments. So my background is in the private equity investment of Unica. We've been doing that for over 20 years. And a couple of years ago, we looked at impact investing, have distanced ourselves somewhat from differentiating between sustainability and impact to keep things simple. And having looked at natural capital in the sense of forestry, we've decided to initiate a program called nature-based, natural capital. And to start off with that, we are focusing on investing in forest assets. And the program called Nature is in a long term meant to accommodate solutions which are bankable with a strong biodiversity focus. And yeah, so that's what we started off with. And just to give an insight on how an insurance group doing these kinds of initiatives works is we start off with a strategic asset allocation, and this is negotiated with the financial market authorities. So that's linking on to what Martin has said. We're strongly regulatory driven. The financial market authorities must sort of sign off our strategic asset allocation, which in this case accommodated for said infrastructure like products. And from that onwards, we are held to display a certain track record I would say, of any investment class. So that means what experience does the market show us in returning the money to investors in a certain asset class? Which data, statistics, indices are available for our risk management to be able to model these transactions. So this is the highly structured area of our funds that are linked to our public offerings of insurance contracts. There is, however, also the opportunity to invest in certain products which have less high scrutiny, and that is something we are trying to set up, to have a certain possibility to gain insights, experience with these markets, and especially referring here to carbon credit markets and to financing possibilities that were cited earlier on. Especially our approach would be moving on from what we had in what we have or trying to build now in forestry investing, to move on to certain nature-based or natural capital, which are very closely linked to carbon markets, which we would approach over managers, which Lydia early on cited as being one of the important stakeholders. So us being a mid-sized insurance group, looking into the fund universe, focusing on natural capital, and are trying therefore to accommodate these in our nature-based program, and ultimately mediating those initiatives with financial market authorities, and them being educated, of course, helps us a lot. So I think I'll pause here and leave the rest to questions later.
Well, thank you so much. Thank you for your insight. I mean, I've got the first short question, since you were mentioning that investing in forests is a part of your strategy. Is it not risky these times to invest in forests, or where do you invest, and what are what's the risk management?
In this case, looking at specific, well, it started off with a lot of inquiries we had from stakeholders locally to invest in Austrian woods, which of course for an asset manager is not highly investable. One must say that. Investable forestry is mainly in the United States, New Zealand and Australia, and to a certain degree also in Northern and Eastern Europe. So that is the first indication of mediating risk, is by diversifying regionally. And with the increasing demand for wood-related products and the increasing technical abilities of managing woodlands, and also increasing their sustainability by sort of dividing plots and avoiding plantations, and actively managing plots, which again, actively managing is something we like to see also in private equity. And we've seen those patterns emerge in managing forestry lands, and also utilizing them in various ways. So if you buy large stretches of land, you can see to it that they are utilized not only for forestry, but also for clean energy sources, recreational purposes, and other schemes for grants and the like. So that industry has developed considerably, and with various managers, again, who have experience and have shown returned, i.e. returned funds to their investors, we'll feel comfortable that this is coming of age, and while still early days, very much look forward sort of approaching nature in all its forms in this sort of what is for us the lowest risk approach.
Okay, thank you so much. It's already, we started a little bit the discussion. We now have, we know all the 6 panelists, and I would like to give all the 6 panelists, the first opportunity to react to each other. So we would like to, of course, still collecting your questions from the audience in the chat, but maybe there are some questions on the panel to each other. Do I see any hands raised? Yes, Lydia?
I actually have a question to the combination of Fabiola and our private sector partners. Is this Seven's approach in having exactly that small difference, that financial loss that's then there to be sold as a nature credit, is that something that has been already discussed in the private sector? Is that something that you as the private sector panelists have heard about today for the first time? If so, is it something that is interesting? Is it something that could work with existing workflows? Or is it something that is still needs a lot of development? And yeah, so I'm very interested in how far this is.
Maybe I can answer. Generally, we see the topic and we notice it, so to say, without really getting into the details of it. We notice it becoming a bigger topic. But my biggest issue with it is that there are still so many questions open, a little bit missing of regulatory guidance also in this area, I feel, which makes it very hard to us to say or position ourselves or actually take actions with this, because what also was mentioned before by Maria is the greenwashing topic that we really want to avoid. There are regulations coming, stronger regulations coming now on this topic, which is this Empowerment Consumer Directive, really limiting all public statements that a company does about its environmental performance in any direction. So that's why we are very, very careful with the topic before taking any actual steps.
Yes, I would only second that. And also in this same direction goes the topic of the measurement, especially for a bank without a KPI, without something that you can properly track and compare and measure. It's very hard to set up any kind of framework and convince, especially the business side here, of any business case. So it's really important to have these measures and also the framework around what is to be measured and how it's to be measured, and which then of course leads into the greenwashing topic, to make it then acceptable to disclose towards the EU. There is a lot of standardization in this regard. So really this setup, this framework, we do have of course the CSRD as a first push towards disclosing on biodiversity, but how it's done, how it should be done by the financial sector, that is still quite vague and open, which of course has to do with the immaturity of the current instruments to measure and to collect data. So we're seeing us in a process, really, similarly to how the climate topic was a couple of years ago, where it is really a process of discovering which is the best metric, which is the best process and the best guidance to follow. And of course, there's lots of international standards. There's the TNFD. There's also the Unified Principles for Responsible Banking, which RBI also is a signatory of. So there is a starting point, but really to actually implement, it needs, I think, a bit more maturity to make it trustworthy, and also for banks to mitigate the risks that go along with investing in any kind of new framework.
Fabiola?
Yeah, thank you so much. I fully agree. So the key issue in the whole thing is the measurement and the KPI that gets chosen. And I fully agree. Of course, claims should be very much tied to a KPI, because otherwise we're very quickly in territory where greenwashing concerns are quite big. And I think that's what we learned from the VCM, the voluntary carbon market, that all these models about avoided emissions are quite prone to issues there. So fully agree, we do need more science on the KPI measurement side then. But we do know that the market already has these instruments in place in Europe, including. So in the Netherlands, there's already large banks that do SLL, sustainability-linked loans, where we, for example, have that soil quality. And we do know that all over the world, if you look at the chat, I put that UNFAO link report there, they will show you a whole range of loans that are already out there that have found KPIs that work in their case. I think the beauty is once you've established one of these KPIs that work, it's then easy to scale, because usually a lot of banks are quite local. So probably there's a lot of borrowers that face similar issues, similar risks. Therefore, the scalability is fantastic. So I think the banks could actually take a leadership role and educate quite a lot of their borrowers once they've done the learning with one of the pioneers, which of course brings down costs and the barriers for everyone else, which scales the impact and is for the bank, of course, also more cost efficient then. Not to forget that a sustainability-linked loan bond always has a KPI. So that's the whole way an SLB and SLL works. So that covenant with a KPI is the whole framework. And that framework is already established. The only thing that's missing is letting the bank or the issuer sell off that impact that is verified. And I also fully agree, the last thing that we are currently also missing and what we're working on is, of course, regulatory support. Any credit would benefit from an official framework that recognizes it. Someone asked it in the chat already. So the EU has not completed that yet. They're still developing the roadmap. The first publications are out. And we're, of course, talking to DG Env and so on to be part of that process and hopefully see what we can do there.
So as a first takeaway message, we can conclude it's not less regulation that is needed here, but more regulatory clarity, probably. I'd like to add a question to our panelists. In the topic of decarbonization, a lot of international activities, initiatives that come from the business side feel a little bit of repercussion from American regulatory side, because they say, okay, if we dare not to be too ambitious in decarbonization, do you see some such repercussions also in this nature positive economy side? Martin, you've got an answer already.
Not an answer, but maybe parts of one, or just my take on it. That as an insurance company, we're here maybe a little bit more on a different way, because yes, of course, there's a lot of headwind and a lot of repercussions, as you mentioned, coming from the US. Just also consumer interest really going very much back on everything that has ESG or sustainability in its name. But as an insurance company, there's nearly no possibility that you jump onto that train, because for us, climate change directly hits our balance sheet. And if there is, last year in our markets, fortunately, there was no big natural catastrophe events, no relevant ones. In the year before, we had Boris in many of our countries, which created huge floodings and very high claims for us to pay. And here, of course, also for us, it's really in our highest interest to have more also nature-based solutions here, because from a risk mitigation perspective, these are, of course, highly efficient. And deregulating a river, as an example, of course, has huge benefits for us in a risk mitigation, but also not that easy, as we're discussing now, for us to also financially support such a solution.
Okay, that's also a nice pun, even that we need more regulation for deregulating our rivers, right? Yeah. Are there more questions on the panel, or should we slowly move to questions from the audience? Since it pretty seems that the panelists are pretty much confident and satisfied with each other. So maybe we have got some critical remarks from the audience. Can somebody with an overview of the questions maybe raise one of the questions, or if you of course can also raise your own voice?
Yes, I can read out the question from the chat. We have one from Stephanie from EcoTree. She asks, if the private sector invests in NbS, like investing in forests and other ecosystems, what would you need from us who are managing these projects to feel confident in the value of the outcomes?
I can maybe answer that and summarize what has been discussed before. Pretty much what we need is very transparent and very robust KPIs. Because unless a project can really prove that it has this positive impact, and then we still, in many cases, have seen in the past, especially with the carbon credits, that it's not quite as straightforward as projects would like you to believe. It is really hard to trust that something has the impact that is then being purchased or sold on. So really, in this case, not to repeat the policy argument, but so long as there is no strict or at least clear framework, what is for a bank a trustworthy KPI and a trustworthy framework that we can rely on and we can consider as proof that something has a positive impact on whether it be the climate or biodiversity, it is really hard to, of course, go forward and risk the investing in the project, or also choose it as a part of the portfolio going forward. So it is really this transparency and this clarity with the KPIs. Of course, also there's a bunch of other factors going into it, but this is really, I think, the key issue currently, because there are frameworks, but they are not consistent and not signed off. I see a question from Mr. Turk about who could sign it off. I would say the European Union, because of course, as banks or also insurance groups situated in the EU, we of course are under the behest of the European regulation. And so anything that is official guidance coming from the EU, from our banking authorities, would then be considered as acceptable framework and something we can then easily sign off. Because we often see projects that on first glance look good and also are maybe local, where you can actually look at the site and prove that something good is happening. Of course, there is mitigating measures now. We also see this push with new technology, with AI, to maybe have additional testing assurances. But really, it's this framework of ensuring that we invest in something or that we promote something that can be trusted.
It is sound. Yeah, thank you. Maximilian has got a point to add on this.
Yes, we like to, in questions such as these, looking a bit into the future, what is coming towards us, we like to look abroad to our partners in the States or in larger institutions in Europe that are developing especially funds and measures to invest in novel topics. So good sparring partners would typically be these fund managers who are offering or aim to offer nature based solutions or natural capital funds that are able to spar with potential investees on business models, KPIs, and the likes, how to combine existing frameworks with business models, and that might also be an avenue to gain more insights of where things are heading. Fund managers, larger institutions, especially large European. Martin said we're a medium-sized and pride ourselves in being smart followers in most things. But the large French, even Italian and insurance groups are very innovative and on the forefront of these initiatives.
May I add on this a little bit? So would you say, a bit contrary to what we discussed so far, that European regulatory institutions should do the signing off? Would you see that the market, other maybe than in the decarbonization sector, where the free market, the voluntary market is a bit not so trustworthy, you see some private initiative to better define the KPIs of the benefits and so on, since you have got this international perspective more?
Yes, exactly. As an example, where we have our ESG-related KPIs, which is taxonomy and the like, is totally unmanageable, and nobody can sort of move on and act on that. Especially the private equity industry, who was always known for its supposedly secrecy, but in actual fact, its lack of efforts to become more transparent, decided on taking a certain key indicators, PAIs and the like, and set up an own set of KPIs just to reduce it to certain manageable amounts and applicabilities. So what happens then is what happened there, at least, is the complexity of regulatory initiatives was reduced by a number of very large and very impactful players, and decided on their own set of criteria, which is becoming more and more adopted. So I think
and adopted universally, so also in the United States, you'd say.
Especially the United States. It was CalPERS and those huge pension funds that decided somehow we need something, but also to coordinate with European investors. So these things are developing, and that's a pragmatic approach. Does not quite fit. You still have to map once in a while, but of course things are moving. And to your earlier questions, in the States, all the people, be it in private equity or in natural timber and the likes, they are continuing to behave as ever on sustainability, of course, but very quiet about it. So that's what we see, at least.
Okay, thank you so much. Lydia, you've got a question or a comment?
Yeah, it's called green hashing. I heard apparently that they are, instead of greenwashing, they are doing green things and are very quiet, and green hashing. No, but I have a question to, because Martin and Max, and also I think Maria, you are also a bit on the same page. You mentioned that the taxonomy is not of much use and also hindering. And we have someone who knows a lot about the taxonomy and also about the inclusion of NbS in the taxonomy. And so I wanted to ask you, Linda, where is this gap? Where what would need to be changed, or is it does the gap lie a bit in the fact that the taxonomy was not written for insurers and banks, but rather for corporates? Yeah, so I would really like to hear your feedback on this particular, Linda.
Yes, can talk a lot about NbS inclusion in taxonomy. I have been advocating for it for the last 5 years, and we've done a lot of work. The experts that sit in the EU platform on sustainable finance, we've been put a lot of efforts. And for the first time last year, we were allowed to publish our brief on NbS inclusion in the EU taxonomy. So that is a public document. And in fact, on the basis of that brief, now in Invest4Nature, we have taken that brief and taken it a step further. And that is also a public document. And now I can, again, go back to the platform and advocate, hey, we really have really good thinking about this. All that we need to do now is define the activities, the criteria, and put it in. Now, there is a big gap. The nature-based solutions are not included in taxonomy in a proper way, and we analyze those gaps and we know what they are, and we have ideas of how to move forward, right? So it really is political will right now. It hasn't been a priority, and even now when I raise it, it still has not directly considered as priority, although I would say that the last 1.5 years, there is definitely more openness on the integration of NbS in taxonomy. Now, there are big questions that we will need to answer, when we do that. Is it's really difficult to include every single type of NbS as a separate activity in the taxonomy and then define criteria for them. It's maybe is necessary because they are so diverse that writing one common set of criteria for all of them may become unusable. But that's the other option, that we put something broad in the taxonomy, right, and captures all the different NbS. So that is a big question. How do we do it right, that it's actually usable, but also possible, in a reasonable time, but also serves the users of the taxonomy? And on that would be great to hear your feedback. So if any of you are willing to read those 2 public documents and come back to us with recommendations on what you think from your perspective would work better, that would be great, right? There is some argumentation saying, no, we don't need to include NbS because the adaptation criteria, for example, already prioritize nature-based solutions, but that is only adaptation, right? Nature-based solutions can do so much more good than just adaptation, and we shouldn't, I'm also the adaptation lead, so I'm myself saying we shouldn't peg nature-based solutions only to adaptation, and certainly they deserve more attention. So currently, because it's been such a long fight to try and get them in, and we've done so much thinking, that currently any kind of feedback would be really useful, that could strengthen our arguments to potentially convince the European Commission to go ahead with that.
Okay, thank you, Martin. On quick reply on that, because then we've got a question from the audience as well.
Only that, of course, it would be very valuable if NbS are part of the EU taxonomy, but for us, still a step prior to that. Right now, the taxonomy is just generally not used in for anything within the management of our portfolio. So that's actually the root issue that I see a little bit, that would need to be tackled, because of the immense complexity also that financial so banks and insurance companies need to take in order to calculate our taxonomy alignment rate is enormous, and in the end very much subject to audits and individual opinions and methodological approaches on how you interpret certain words and sentences, which makes it unfortunately so uncomparable and hard to use for us. Also for insurance companies, we have an additional dimension next to our investment KPI. We also have an underwriting KPI, which now is reworked, thank God, and where there are drafts of changing that. Unfortunately, not including anything on the biodiversity area. This is just related to natural catastrophes and covers for natural catastrophes. So unfortunately for us, the whole concept of the taxonomy right now is not really being used.
I'll try to give you some hope. We have really strong representation of insurance sector right now in the EU platform on sustainable finance. They did already provide some feedback into amending only the adaptation side. Obviously, there's no talk of including any other specific insurance aspects right now.
Yeah.
But the other encouraging thing is that the Article 8 Delegated Act, or the Disclosures Delegated Act, is also open for review. And so again, you know, any kind of feedback is really useful to help make it more useful. I think there's a bit of a problem that a lot of these issues that you describe arise not because of how the regulation is written, but how different players in the market are over-interpreting. So your lawyers, your auditors, your consultants, they are presenting it way more complex than it actually is. So there's this over-interpretation problem in the market, which I kind of hear through you. You know, it becomes this battling about single words and, you know, legal interpretations, but really it should be a tool that helps you guide investment flows, right? And I think what we need to think about, and you know, the only way that I can see it is give better guidance, right, from the European Commission, from the entities' official guidance. And again, something that we have been advocating for as the platform for 6 years now, right? And it might be me personally. Again, a little bit more openness, I think, lately to work on guidance. But I think, yes, there's just so many players in the market that are also misinterpreting and kind of complicating things unnecessarily. And so I think it's two fronts. We need really good inputs on how the regulation itself can be improved to become more usable. But then again, the other thing is, how do we battle this, you know, intermediary problem of overinterpretation?
Okay. Yeah, thank you so much. We have got one more question from the audience. Anna Hausner, would you like to raise your question yourself on CBI resilience taxonomy? Are the panelists aware of that, or would you like to explain it a bit, maybe?
Yes, hello. Thank you for this very interesting panel discussion. I started using the CBI's resilience taxonomy in a project as a way to precisely find some kind of international standard that would bring confidence to a financial institution. And I just wanted to know if you had some experience with that particular international standard or any other one that, because you mentioned the EU taxonomy is not so used. So yeah, that was the question. Thank you.
Anybody would like to answer on that? Linda, you said you know it.
Well, I can
What do you
jump
think
in.
of it?
Yes, I do know it. Look, as an adaptation lead for the EU taxonomy, of course, we are aware of all the sustainable finance standards that connect to adaptation resilience. Look, CBI is still a voluntary standard, and now Europe has its own green bond standard. And so we are seeing quite a rapid rise in issuances in bonds that are aligned with the EU green bond standard, which ask for 85% of allocation of proceeds to be taxonomy aligned. So we're actually seeing quite a rapid use of taxonomy use increase in the bond issuance space because of this alignment with the EU green bond standard, which also means that these bonds are no longer using CBI. So we're seeing a bit of switch, right, from certain type of issuers away from CBI to an EU standard. But CBI, of course, will still play a role, especially internationally. But have it's completely voluntary, right? It is, you know, it was one of the earliest, and in fact, some of the inspiration for the European taxonomy came from CBI, and CBI themselves are, you know, were very actively involved in developing the EU taxonomy. Now, the problem with CBI is it's very specific purpose built. It's built for bond issuance, right? And there's certain other uses where it will not be as useful. Certainly, when you want to apply something on an entity level, then CBI is less useful. It's really project specific. It's really good for projects. So, you know, my recommendation for you is, if you don't have mandatory obligation to use the taxonomy or mandated frameworks, yeah, shop around and find the ones that work good for you. And CBI is good. It's reputable. There's no big risk of greenwashing. So it's one of the good ones.
May I add a question rather out of personal curiosity, since, you know, my background is risk economics and insurance. I mean, if I invest in some natural assets, yeah, and some nature-based solution, I have got the problem. Well, it is a resilient solution, but still it is not providing its benefits all the time, because nature has got its natural virulence, but also, of course,
is responding to climate risks, for example. And so if I think about a nature-based solution for cooling cities in Southern Europe, maybe in mid-August, when it's needed most, it's not a green solution, but a brown solution maybe. Okay, so if you are talking about KPIs, would you be prepared to get these KPIs, you know, not as a for sure KPI? Maria Elisabeth, you were mentioning you want to have robust numbers, but actually it's like an insurance product. I mean, you get coverage maybe in 90% of the cases, but in 10% of the cases you don't get the coverage. So value at risk would be a way that in the financial sector is an understood concept. So what about that?
Yeah, I mean, mentioning the cooling of cities, I think in this case in particular, looking at large infrastructure projects that are often financed also by governments or by local municipalities. This is actually something that we have discussed also. This is the whole blended finance approach of really having different investors coming in. But then it's often, especially the larger projects that would make sense to finance, are often driven mainly by governments and financed mainly by governments or by the EU. And so as a private investor to come in here is not the easiest, but of course those would be attractive projects. And also, since you mentioned the 90-10 ratio or even a different one, I think it is quite measurable. You see with the example of Paris, who have invested a lot in their infrastructure in greening the city, and they really were able to measure the success of that with the lower temperatures. I mean, of course, now we're in an extreme situation, and also the reduction of particle dust in the air and just improving air quality in general. And this is absolutely tied to their increase of biodiversity and greening in the city. And so having something that is either a blended finance project where you have different investors coming in, also the state coming in as an additional insurance for the financing, because it is a project that is long-term and that of course has then long-term value, that is attractive for a bank to finance. But those are of course not the majority of projects that we would talk about or are faced with. Those tend to be smaller, and therefore you have maybe higher transaction costs, and it's more complex and therefore difficult to scale by comparison. So yes, on the one hand, but on the other hand, hard to invest in from a banking perspective.
Yeah,
or
because
at least
also,
that's our experience.
The public money needs to be there because it is public goods that are being produced.
Exactly.
The coolness of a city is, of course, something that everyone profits, and it's not only individually financed. Okay, Lydia, one more question or comment from your side?
A reflection on this, actually, because you brought something up that we haven't addressed so far, because we saw also what I presented, this huge public sector bottleneck, that the public sector is the bottleneck in most of the projects, and that there would be it would be beneficial to also legally and in terms of management and bureaucratic processes and so on and so forth, enable the private sector also to more independently of the public sector invest, finance, and also maintain and do NbS. But also, I think it's a very interesting point that you raised, that the public sector, especially large cities and larger entities, should think, when they are planning and thinking about NbS, if they have a project that they would theoretically be funding as, for instance, the city, but they see it's highly investable for the private sector, maybe bring the private sector in on that one, and use the funds they have for different projects that are less investable by the private sector. So also kind of so that the public sector doesn't reap those fruits of the investable projects, but rather kind of also focuses on those things that are really not for the private sector, not investable, too small scale, and too difficult. So there might be a number of projects where the public sector has financed them, where the private sector could have also participated, just because the processes weren't there and the awareness wasn't there, and because it's just the way things were always done. So this is a really important thought that you give to us for future research projects to take with us. Thank you for that.
Oh, very welcome. I think in general, we see this more and more also with topics like circularity, to have really cooperations with innovations, with startups, with multiple entities, really is the way to go to bridge this gap, where on the one hand you have a very high risk of uncertainty and of new projects where you're not certain that they will be able to succeed long term. And so to mitigate that risk, any kind of cooperation that you can join in, or especially bringing in the public sector, is very valuable, because of course there is a lot of risk buffering on that end, and especially with large infrastructure projects, there is a public interest there. And so banks can come in and be assured that this is going to be financed and going to be implemented because of the public interest. And so really to go into cooperation and awareness raising, I think, is a good step forward as well.
Okay, thank you so much. I mean, slowly our interesting discussion is coming to an end. We've got 2 more minutes. I will try to do some wrapping up. Canisia, are you? Do you like?
Yes,
do you want
I
to
see
add something?
There is one final question. I don't know if you want to. It's just one. Perhaps we can.
Yeah,
go
well,
very
it's
quickly.
on the ceiling of
Yes.
of surfaces. I think we need to discuss this bilaterally afterwards, because I think it's also good to do a little bit of wrap up. What have we seen? What have we discussed about? It has been said that there is more regulatory clarity needed. So not necessarily less regulation, but balancing, regulation that is explaining itself without too much of overinterpretation by those who make money out of being it very complicated, if to put it politely. Then there was this big question: what are the KPIs that measure the benefits? Who signs off that? So we have both views that, yes, of course, in Europe, the European Commission, in a very heavily regulated sector as banking and insurance, they could do quite some clarification in the already existing regulatory frameworks. But then we have also saw that, for example, there are fund managers of NbS funds, and that a lot of clarity and also practicability is coming also from the private market. So the private equity community comes up with manageable KPIs, and it is moving in the right direction. Also on the other side of the ocean, where we learned green hushing is rather the fashionable thing nowadays than greenwashing. Yes, and then we also discussed the entire topic of blended finance, public-private partnership, where of course a lot has to be done, given that there is scarce public finance pretty much all over Europe. But of course, private capital could step in financing the long-term benefits that we all want to benefit. Okay, with nearly punctual closing up, it's 11:01. I thank you once again very much for all your contribution and your interesting insights. And I'm very glad that we also could do some networking and continue be in contact to do something in favor of this important topic. Thank you so much.
Thank you. Goodbye.
Thank you.
Thank you.
Bye.
Bye.
Thank
Bye-bye.
you.